Hello and welcome. Welcome to our next NEP. NEP stands for Nonprofit Auditor Points, and I'm your nonprofit auditor, Irina Ryshkova. I have a small CPA practice in downtown Oakland, and we serve nonprofit organizations exclusively. These videos are not authoritative in nature. This is just me sharing my experience and knowledge with executive committees, executive teams of nonprofit organizations, board of directors, accountants, and bookkeepers. Hopefully you will find these videos helpful. This is my third and last video on the topic how effectively close the books and prepare for the audit. In my previous video, number 1 and number 2, we talked briefly about review prior year audit report, review the list of adjusting journal entries that auditor prepared, make sure that net assets from last year agree to net assets on your audit report, make sure that you run comparable balance sheet and income statements and see if there's any accounts that have zero balances this year, had balances last year, or if there's any accounts that did not change balances between years. All of those red flags that needs to be considered. And lastly, we discuss that on a balance sheet, all assets and liability accounts should have some sort of reconciliation schedules. For cash accounts, bank reconciliations; for investment accounts, bank reconciliations; for AR, accounts receivable, AR aging; for AP aging; for fixed asset schedule plus depreciation; for right of use asset, you need to have a schedule; for prepaids, schedule of prepaid expenses; for deferred revenue, schedule of contracts that are prepaid and create deferred revenue. And pretty much for every balance sheet account, you need to have reconciliation schedule. Okay, now, last video, we're gonna talk about P&L, profit and loss, and related net assets and missing transactions, how to identify them and what the common missing transactions are. Okay, let's start. So first of all, the organization needs to make sure that it has a good, robust schedule of net assets. Unfortunately, majority of nonprofits prepare net asset schedule at the end of the year. Ideally, net asset schedule needs to be maintained current throughout the year. How do you do that? You can do it throughout the year. Definitely highly recommended to do it throughout the year. But if you don't do that throughout the year, at least make sure that you've done it when you're preparing for the audit. You need to, for every grant, for every contract that organization received throughout the year, bookkeeper need to make sure that bookkeeper has a copy and read the contract fully. Sometimes the contract can be 32 pages long. Yes, you do need to read it once and make summary of the contract. So what I would advise you to do, first of all, because nonprofit has two types of revenue: exchange revenue and gifts, grants. You need to identify, is it exchange transaction, meaning you record revenue when it's earned, exchange, or if it's a grant, meaning you will record when it's unconditionally promised. So first of all, you need to identify, is it exchange transaction, or we call it contract, or it's a grant. And then you will see, okay, if it's exchange transaction, then we will record revenue as it's earned. And accountant will need to ask that's a typical billable contract, right? So you need to make sure that you invoice the vendor, you invoice your customer at the end of the year. If it's a grant, then you need to see, okay, is it unconditional or it's conditional? If it's truly conditional, then you don't need to do anything until the condition is met. Make sure that you outline condition. It needs to be barrier plus right of return of the funds, measurable barrier. If no measurable barriers and right of return the funds, then it's an unconditional promise, and you do need to record it full amount. You also need to consider if it's a multi-year grant, then it will be restricted by time, or if there is restriction by purpose, right? So you will write, we typically have, when we analyze every letter, we'll write like between 5 and 10 points. We'll say it's a contract, exchange transaction. That's done. Or if it's a grant, we're going to say it's unconditional, but it's restricted by time and restricted by purpose. We'll write. And the amounts, this is how the payment's going to come in. And therefore, we would expect X amount of dollar to be in accounts receivable. The rest will be part of the net assets with donor restrictions. Write it on the top of each grant. When you analyze the grant or contract, it shows that organization has a process how to record revenue correctly. Even if your organization mistakenly concluded that it's a unconditional versus conditional or anything, when you go through audit, you can substantiate your point saying that we do have a system of controls and procedures that our nonprofit used to assess each grant. We just mistakenly identified it incorrectly because XYZ. So what it shows to auditor, it's not that the organization does not have a system, does not understand revenue recognition. It just shows either honest mistake, or maybe you will even convince the auditor that auditor assessment was wrong. So make sure that you do follow that process, because whether you will write it down, which is going to take 2 minutes or not, you still need to record revenue, and you cannot record revenue until you know what is it, grant or exchange transaction. So do that. And as you analyze for your revenue recognition purposes every grant and contract, you will identify all restricted donations that either restricted by time or restricted by purpose. One warning, lately we identify a lot of nonprofits that I understand very well restricted by purpose. They know exactly where the money can be spent. However, they completely ignoring restrictions by time. Please note, restriction by time as important as restriction by purpose. If the nonprofit receive a grant that says it's for the period from 2023 to 2026, and even if they give you all money up front, it's still restricted by time. It needs to be included as donor restricted grant, but it will be restricted by time. Therefore, so as soon as you analyze all your grants and the contracts, you know full list of restricted donations, either by time or by purpose. And those will need to be included in your net assets with donor restrictions as additions. If any amounts were released during the year spent, you will release them and you will know ending balance for each restricted grant. And that's going to be your schedule. So your schedule of net assets goes hand in hand with the revenue. So we would advise you to prepare your schedule of net assets while you reviewing and cleaning up your revenue, recorded revenue. One warning, if as a bookkeeper, I would advise a bookkeeper, make sure to ask your executive director or operational folks, whoever you have a contact with, if nonprofit receive any endowment funds. Endowment meaning restricted in perpetuity by donor. So just to make sure you don't miss that. One warning to all nonprofits. Before any nonprofit will start truly receiving endowment funds, we call them endowment or restricted in perpetuity by donor, your nonprofit should have a written policy for endowment funds. That policy needs to include where the funds going to be invested, how are they going to be segregated from the rest of the funds, expense policy, spending policy, how much organization can spend annually, dividends and interests, and so forth. So that policy needs to be in existence before any nonprofit receive any endowment fund. Make sure that you as a bookkeeper ask your executive team, is there any endowments we received, or if there's any amounts that board decided to designate. Designated funds are not endowments, they just designated by board, but as a bookkeeper, you need to know, because in the net asset section, you need to separate that amount and present it separately, because by definition, it's not available for use because board put it aside. It does not mean that the board cannot change their mind next year when the money is needed, but as you as a bookkeeper, keeping the books in accordance with the board wishes, you need to make sure that you separate if there's any funds designated by the board. And that's going to be in net asset section is pretty clean, and revenue section is pretty clean as well. Now, last point that I want to talk about, it's in missing transactions. Very common missing transactions that we encounter are two transactions. Actually, I would say three. Let's do three. Number one, in kind. In kind is the biggest missing transactions. And there's a lot of misconceptions out there. Let me clarify. There's two types of in-kind. In-kind professional services, in-kind goods, and also three, and in-kind rents. Okay, in-kind professional services. Any professional services that were given to nonprofit free of charge or below fair market value are in kind. Now, if you have financial director, executive director that does not receive a compensation, it's considered professional services regardless of their qualifications. Executive director, considered professional. And you do need to assess based on fair market value. It's not how much I perceive my services cost. I might believe my hourly rate should be $2,000, but nobody would pay me for $2,000, maybe $200 an hour. Then $200, and that's going to be fair market value. Once again, financial director, executive director, always in kind if they're not paid via payroll. Other professional services that very common are attorney's fees, fundraising consultants, accounting, any other professional consulting firms. That would be professional services. Another in-kind is goods. Nonprofits can receive donated properties, computers, donated condos, piece of arts, gift cards, a lot of school supplies, a lot of household supplies, food for their food pantry, for example. Those are in-kind goods. And also, a lot of nonprofits receive in-kind rent. Rent would be if nonprofits receive free rent or below fair market value rent. For example, to rent the office, typical cost would be $5,000, but because it's nonprofit, they were allowed to rent at $2,000 a month. Therefore, $3,000 needs to be recognized as in-kind. And these in-kind transactions are very often missed. And the reason is because operating group does not communicate to accountants. Therefore, it's up to accountants to initiate the conversation and say, did we receive any in-kind donations? bookkeepers very often would not know if there's any in-kind donation existed. Number 2, long-term leases. If organizations signed any long-term lease contracts, long-term meaning more than 1 year, they have to give it to the bookkeeper, and bookkeeper need to record right of use and liability. A lot of bookkeepers do not record it because they're not aware that such lease was signed. And operating people would not give lease agreement to bookkeepers because they don't know that bookkeepers need them. Therefore, bookkeepers need to initiate that conversation and saying, can you please provide me all new leases that we signed this year? And last most common missing transaction, it's a capital campaign. It does not happen often, but when it happens, it's very material. When your organization decided to run a capital campaign, then your executive director, your board members start going around and collect pledges. And for example, nonprofit need $10 million. So a lot of donors will say, when you have collected $10 million pledges, we'll give you money because, for example, you want to build or remodel building, you need $10 million. So even if you collect $2 million, it's not very helpful. So you need to have the full balance of $10 million. So when your team is out there collecting pledges, sometimes they are conditional. And if they're conditional, you would not record. If, for example, it's matching conditional, they say, until you reach $10 million, we're not going to give you any donation. But if you reach $10 million, then we will give you that pledge. In any regard, if it's unconditional promise that board members collected or executive director, these promises needs to be recorded as pledge receivable at the end of the year. So if you're aware that your nonprofit is doing capital campaign, you need to ask how much pledges, unconditional pledges were collected at the end of the year. And last point I want to make. Bookkeepers, by looking in accounts receivable and accounts payable, would not know which receivables and payables are collected or collectible, especially receivables. Therefore, it's very critical for executive team, executive director, sit down with your bookkeeper and discuss what receivables are collectible, what are not collectible. And if any receivables, especially material receivables, will be identified as uncollectible, they need to be written off at the end of the year. And last part, when you've done all of it, and if your nonprofit have been through audit last year, the great roadmap would be pull your prior year PBC. PBC stands for prepared by client. We as auditors send comprehensive PBC list to our clients every year with all the detailed selections and so forth. You can ignore selections, but you can look in a general schedule that we ask. We ask bank reconciliations, bank statements, prepaids, fixed asset schedule, right of use schedule, so forth. Use your prior year PBC as your roadmap. What documents needs to be collected and what needs to be prepared. And if you do that along with your year-end process, I can reassure you, you all very well prepared for the audit. Your audit going to be smooth, and you're going to feel very confident, and very confident that you will do well, and any auditor would be super happy to have you as a client. Thank you so much, and I really appreciate your time, and thank you for listening. Hopefully you will find these videos useful. If yes, please subscribe, and I will see you next time. Talk to you soon. Bye-bye.